I'm gonna actually just run through really quick the other sales that I got this week for the 4,200. So the first one was a referral. Michelle, she actually was also looking for whole life as well. We're gonna potentially start running into people that want investment vehicles and they're just looking for the wrong product to accomplish that. So I'm going to talk a little bit about that in the training, but Michelle, I helped her apply with a $71 app. I'm going to meet back with her for investments as well. Then I had Heather, who was a field training appointment. I'm training this awesome couple that I'm working with right now. They're actually taking their test today at 1:45 and 2. The husband is active military now, and the wife is looking for work, but she has a daughter that is really under a year old, I believe. And so she's joined the business. Then we recruited the husband. They're teaming up together. They're super sharp. They're just excited to learn. And we sat down with his sister, and she has Fedley. She's a federal employee. And we went over how the multiples in federal employee group life insurance goes up every 5 years, killed that, and we helped her apply with a $116 app. So that was there. And then I'm going to talk about the big client, Fantasia and her kids, who we helped with a $166 app and two $19 apps. So that's the 42. But yeah, so let's talk about this, right? Leaving a legacy the best way for your clients. Again, a lot of people are going to be looking for ways where they can save and invest, but they're getting the wrong information. And we've talked about it trains back to back to back, where people are looking for cash value to create investments. So you want to master your craft, and the more you go on appointments, just like how Samir was talking about increasing the denominator, it's the same thing with your appointments. You want to set a lot of appointments and go on a lot of appointments so you can master it. Right? We want to make sure that you understand the ins and outs of buying term and investing the difference. And when we sit down with families, there's only 4 scenarios that you're going to see and run into, right? And so you want to master those. The first one is you're going to meet them. They have absolutely no coverage at all. Second, they have something through their job, employer coverage, or if they're a federal employee, they might have coverage there, or if they're a military, they may have SGLI or VGLI, which is Service Members Group Life Insurance and Veterans Group Life Insurance. And then if they have their own private coverage, they're going to have a term policy or cash value, whether it's whole life or universal life. So you want to master all of those areas. So anybody you guys talk to, you can have a conversation. And our presentation is already developed and has all of those areas in there for you to master. So who is our client? It was a referral. They're actually a married couple in New Jersey. The wife is a homeschool teacher, stay-at-home mom, and she was actually doing HR work in the past. She's been at home, I think, now for about 6 years working with her kids. The husband is a longshoreman. I've never heard that before, but you've heard it before? Okay, cool. Doing import and export in the docks in New Jersey, and they make about $320,000. So doing pretty well for themselves. They have 6 kids, a 17-year-old, 6-year-old, 10-month-old, and then a 19-year-old and 21-year-old. And so when we met, they're like, hey, we have some policies. They had some coverage already. The wife had $100,000 of whole life, which she just got 6 months ago, and she was paying right under $200 a month for it. I think it was actually like $140. And then the husband already had term insurance, and he had $2 million, was paying $160. So when I saw that originally, I was like, why are you guys looking for whole life? You have so you already have term insurance with a lot of coverage, paying significantly less. But from what they've been seeing and hearing, right, they wanted to create generational wealth and leave a legacy, and they thought that a whole life policy would be the best option for their kids to be able to do that, right? So what did I do to kind of overcome it? I just asked a series of questions, right? When a client has something that they're looking for, you got to figure out what their objective is and why do they want that outcome. Right. So number one, I asked them, have you ever worked with a financial advisor before and discussed investments? So just from that, they said, no, we actually haven't. We're very new. We don't know much about the financial industry. We just saw something, heard something, and thought that that would be the best option. So then obviously we have the opportunity to sit down with people and talk to them about insurance and investments. So we have a leg up on what people are just seeing about life insurance out there. So that was huge. And then also, why do you want to ask those questions? Because right away, yes, we want to kill whole life and we want to kill cash value. But if the client doesn't know that or doesn't know the differences yet, you don't want to beat them up for that. They might not know any better, right? So you want to ask the questions to make sure that you're just figuring out where they're kind of at in the process. Then I just said, hey, what did you guys want to accomplish for the kids? What are the objective? And again, they just wanted their kids to have access to some money and start saving somewhere and start investing so they can be able to utilize that and create growth for the future. So I went through, I used one of our slides in our presentation, right, which goes over the bank's example. So whole life can be very complicated for clients to kind of understand. So we have a simple explanation to break down how it works. So I just went through that with them, and it was just funny, their responses afterwards. So real quick, like Annette, right? If I went through this with you and I said, hey, you just want to save some money. Let's just talk about that first, right? And you're going to put your money in the bank. Tell me which one you would prefer. Your money to grow at a higher rate of return or lower rate? Higher, right? Second, if your money's in the bank, would you prefer it belong to you and be liquid or belong to the bank? You got to borrow it and pay interest to take it out. Of course, right? And then if you pass away, would you want all of that money that you saved up to go to your survivors, or the bank to say, hey, well, I know when people pass away, a lot of people fight over the money, so we'll just keep it. Okay, right? So just like how you guys are laughing, the husband, when I said that, he was like, why are we even talking about bank? Right? So with that, just going through this example, they understand that this is really bad. But at this point, they don't understand what this bad bank is. So then we're going to let them know, well, hey, when you have a whole life policy, that cash value, the investment portion of that policy works exactly like bank B. What you said you don't want, why are we even talking about this, right? So now they understand. And so what I did at that point was I asked her, I was like, hey, do you have your current whole life policy? And she was like, yeah. She went and she grabbed it, took a couple minutes, I was chatting with the husband, and then she brought it back. And that's when we figured out it was actually $140 a month that she was paying. And so that's about $1,700 a year. So I just kind of went through some of these bullet points and kind of explained it within her policy. So if she is paying $1,700 a year, it said after 31 years, her cash value would be at $52,000. But if you multiply, she would pay $52,000, sorry. But then her cash value would only be $39,000. Very easy. So Mr. and Mrs. Client, would that be a good investment? No, they're going to say no. It's super easy. So then I'm going to explain what there's other investment options that you could look into, right? So I asked them, I was like, hey, have you ever had a 401k before? They're like, yeah. And the husband was like, I have one now. Perfect. Well, if you've had a 401k before, you're investing in something called mutual funds. Have you heard of those before? Yeah, we have, but we don't know exactly how they work. So I just explained a little bit about how mutual funds work. This is a good way of how I do it, how I was kind of taught to explain it really easily. But a mutual fund, right, is just a grouping of stocks. So who's the Apple user here? Oh, there's not even that many. Android? Android? Okay, y'all gonna raise your hands first when I said Apple. But anyways, let's say for example, somebody had $100,000 in Apple stock, right? Awesome, a lot of assets there. Stock is when you're just invested in one company. Now, what happens if Apple goes out of business? Yeah, $0. All your money's gone, right? Don't worry, Samsung's not going to go out of business anytime. Right. So then what I compare is, well, a mutual fund now is anywhere from 100 to 200 different stocks or companies. So now your investment looks like this pie chart, and I draw this on my computer and it looks just as bad as it does here. Don't judge my drawing, but let's say now, for example, Apple is this piece of the pie, but then you have Exxon, you have Johnson & Johnson, you have Walmart, you have Samsung, you have T-Mobile, right? All these other companies, 200 different companies. if you have the same $100,000 invested here, but Apple is just this piece of the pie, do you lose all of your money?
No.
No, right? So a mutual fund allows you to kind of minimize the risk where you're investing, but increases the diversification, right? And then they were like, oh, okay, that makes sense. And I'm like, exactly, that's what's in your 401k now, Mr. Fine. So if we can utilize that, we can have better investment options than what you would have in a bullet. Any questions on that? All right, cool. So that's what I did there. And then I went through an example of a policy while they were looking at their policy. So you want to make sure that you're always prepared. And if you don't have any example policies, talk to your trainer, get one so you can show them. I've had the same one ever since I've been in training, and Samir taught me about this policy, right? So this is a whole life policy from New York Life. The client was 28 years old, right? So they want it for their kids. So this is a relatively young client, right? Wanted $133,000 in coverage, paying $212 a month, right? One of the things that I mentioned to the client, I was like, you guys have 6 kids. If you got a whole life policy for all of you and all 6 kids, you're going to be paying hundreds of dollars a month. And the husband was like, well, I know it'll be a little more expensive, but we just want to create that investment. So people are willing to pay more if they can get a better outcome for their kids. So if we can explain that this is better than this, we can help them, right? So $212 a month. Now, we show them something called the table of guaranteed values, which is what the investment's going to grow to over time in this cash value policy. So they're paying $212 a month, which is $2,400, let's call it, per year, $2,500 or so. So I just asked Mr. and Mrs. Client. Mr. and Mrs. Client, after the first year of putting in $2,500, how much money do you have? Nothing. 2 years, you put in $5,000. How much do you have now? 1,600. So I showed that here, and then I asked them to look at their policy, right? And then they started saying, oh man, there's nothing there, nothing there, nothing there. I said, okay, well, what if they tell you, what are they going to tell you about your contract? They're going to say, hey, this is a long-term investment. So let's fast forward. In this client's example, fast forward to age 60, the client was 28. So that's 32 years later. At 60, they have 63,000. Anyone want to pull out a calculator really quick? Do 2544, I think that was the annual premium here, times 32. Tell me what you get. 81,000. This is a good investment?
No.
All right, so you guys, so the client, I said, you guys have your policy where we just said it's not a great investment. This is a whole nother client, not a great investment. So now they're seeing it when I'm showing them and in their policy, right? Then I want to explain to them that they're not going to get the cash value if they pass away. And if they do take any money out, they're going to have to pay interest, which is what we just went over with banks, right? So in every contract, there should be a definition of life insurance proceeds. And it's written by a lawyer, so it's very complicated writing. But when you look at it, it says these proceeds will be payable to include the face amount of the policy and the following. So the face amount would be the $133,000 that we talked about. And then any benefits from riders, paid up additions, or dividends payable because they're dead, plus, so now we're adding money to it again, any part of premium paid for the period after the policy month which the insured dies. So let's say, for example, we're in March, right? And they make their premium payment for March already, and then they die in March, right? So they'll get that premium payment back. But let's say if we go here, it says less. So now they're taking money out. 1 month, the premium for 1 policy month if the insured dies during a grace period. So let's say we're in March, they only made their last payment in February. They're going to take out the premium payment for March. And then less any outstanding policy loan and accrued policy loan interest. So what is that saying? If you do have a cash value and there's money there and you took some money out, when you die, they're going to reduce your cash value by that loan and the interest that was growing, right? And then I'll say, is there anything else there, Mr. and Mrs. Klein? The death benefit. Sorry, yeah, the death benefit. So we're going to take that out of the death benefit. So I'll ask, is there anything else listed here, Mr. and Mrs. Client? Do you guys see anything about the cash value? No. You think they left that out for a reason? Right. They're not going to give it to you. If it's not listed, you're not going to get the cash value. And they're like, that's crazy. If I'm paying all this money for the cash value, if I die or if my kids die, they're not even getting any of the assets that were so-called created. Does that make sense? So now at this point, they're just like, okay, I get it. Doesn't make sense. This is not what I should have. But we got to put the nails in the coffin, right? So now we're going to show them the difference if they were to buy term and invest the difference instead. So if we looked at that same client that was 28 and they got a term policy with us, it'd be about $50 for $500,000 versus $133,000, right? So that would leave over $162 that they could invest. So if he was able to invest that money for 32 years, he'd have $575,000 if it grew on average of 11%. And if we're saving our money in a cash value that usually on average will grow maybe 1.25%, mutual funds, you can get 11%, which would be better. And you just show them, this is what it looks like. This is what it's growing to over time. And I just asked, Mr. and Mrs. Klein, what do you think would be better for you? And then more importantly, for your kids, the whole life policy or buying a term and investing in it? What do you think they said about? Exactly. That's it. So it was super easy. And then at that point, we confirmed and we went over options. We were able to help the wife apply for $750,000 plus a $50,000 child rider for her 4 kids that are under 18. That was $166 a month. And then the 2 adult kids who are over 18, they each got $50,000, paid $19 a month. And we're going to be meeting back up with them once the wife gets approved to go over investments for the whole family. Now, why is it important to learn this stuff? Look at what you guys can make, right? You're here to make money. So when you look at it, the annual premium that was collected from the client from this, and this only took me, I think, 45 minutes on Zoom. Okay, 45 minutes. So $2,400 in premium. Where I'm at right now, senior regional leader, 80% contract. The advance is $1,400, but my total comp is almost $2,000. Right? If someone's brand new, you just learned this, you're still making $500 in 45 minutes. Working somewhere part-time, getting paid hourly, there's no way you're making $500 in that amount of time, right? District leaders, $920, divisions, $1,100. So, guys, was this complicated? You guys think you can learn this? Great, it's not that hard. We got to go out there and teach people this information because so many people are looking at the wrong products. And all we got to do is teach them and help them understand. So anyone have any questions? Yeah.
So term is better than whole life?
Term and investing, the difference together is better than. Does that make sense? You sure?
Yes.
Okay. So people will say, hey, term ends. It doesn't have an investment. Whole life could be forever and it has an investment. So we can't compare an apple to an orange. We got to compare apples to apples. So if you want an investment, well, let me explain how term and investing in mutual funds is going to be better than your whole life. Sense?
Yeah, the question. So you can only withdraw cash value like at the age of 100. That's the only time you can get it without any loans or anything.
No, you can take out money from your cash value if there's any money in there, but you will have to pay interest when you do take money out. Does that make sense?
Yeah, you always have to pay interest.
Yeah, it's a loan on the policy. Anyone else? All right, that's all I got. Thank you.